Good morning, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, July 28th, 2022, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we do show futures are lower. Dow Jones futures down about 40, S&P 500 futures down 10, NASDAQ futures down a little more than 75. Crude oil prices up a couple bucks. Currently $99, a little over $99 a barrel. I'll show you a chart there. I think crude oil is at a critical juncture on its chart. The U.S. 10-year Treasury yield back up 5 basis points this morning, back to 2.78%. Still, we're 70 basis points off of the high that we saw a few months ago. So I think the bond market continues to send the Fed a signal. We did get the Fed announcement yesterday, and while they did follow through with their 75 basis point hike as expected, I think some of their language changed a little bit. Now they're talking a little bit more about being data dependent, and they're open to the possibility of maybe less aggressive hikes. I think, their tone's beginning to change. I actually think they hiked for the last time yesterday. We'll see what happens at their next meeting, but I believe we're going to see inflation numbers come back down. I think that's going to maybe change their fight from inflation to the recession. Speaking of recession, we got the GDP out later this morning. So we'll find out if we get our second consecutive GDP reading below zero. Of course, that's kind of the old way of determining whether or not we're in a recession. I still like to use it just because it's easy. But we still look at other factors in the economy to see whether or not, in fact, it's technically declared a recession. So still some work to go there. Yesterday, Jay Powell said he didn't think we were in a recession just yet, but he did acknowledge that things were slowing. Well, I think that part's pretty evident. Anyhow, got a lot to go over today. So let me walk you through today's agenda. I'm going to start off with that daily market recap, talking technically, relative strength, which I find to be extremely important. I talk about it a lot here on the show. We're going to spend a few minutes going through a couple of charts there. Earnings spotlight, Meta is in the spotlight this morning. Not so great report, not so great reaction. I think that's certainly contributing to our weak futures this morning. And then we'll wrap up with the three you must see. I'm going to give you three indexes this time, as opposed to three individual stocks. Just three indexes I think are worth keeping an eye on and making sure you're aware of what they're doing, because they could have a huge impact on what happens in the market. All right, let me walk you over to earningsbeats.com. If you are unfamiliar with Earnings Beats, go to earningsbeats.com. Scroll down. We have a free newsletter. We'd love to kind of bring you up to speed, some of the things that are important to us. This is a 3 times a week newsletter, Monday, Wednesday, Friday morning. Try to get it out around 8:30, which is about an hour before the market opens. All it takes is your name, email address, hit that subscribe button. This is completely free. No credit card required. You can unsubscribe at any time. We'd love to have you. A lot of times focusing on earnings, gaps, candlesticks, relative strength, those things, moving averages, trend lines, things that are important from both a technical perspective, also fundamental perspective. So I think we're one of the few services that focuses a lot on both. I believe it's really important to use the technicals to determine entry and exit points, but I also think it's really important to remember what the fundamentals are doing. I think that is part of the puzzle to figure out what's going on in the market. And I also think that it can help us in terms of selecting the individual stocks that we want to consider. So anyway, if you want to learn more about us, go over to earningsbeats.com, scroll down, and make sure you sign up for our EB Digest newsletter. Okay, let's look at the action from Wednesday, because it was a good day for the bulls. There's no, it's hard for me to imagine bears just continuing to look at this action and believe that we're going back to the downside. I just don't see it. Dow Jones Industrial Average up 436 points yesterday. S&P 500 up 103. NASDAQ up 470 points. Mid caps up 46. Small caps up 27. You look at it across the board, everything up really nicely, but that NASDAQ gain over 4% really stands out. And the reason it really stands out to me is you had two major NASDAQ component stocks, Microsoft and Alphabet or Google. Both of those companies missed their revenue estimates, missed their earnings estimate, and the index goes up 4%. I mean, think about that for a minute. What's the market telling us? The market, one thing it's telling us is could care less about what just happened in the last quarter. It's looking ahead. Leading yesterday, technology up more than 4%, communication services up more than 4%, discretionary up nearly 4%, energy up 2.25%, industrials up 1.5%. The makeup of the rally, very, very strong, very bullish. I mentioned energy earlier, talked about an energy chart we're going to be taking a look at in a little bit. I think crude oil prices are getting to a level where we want to really kind of watch to see whether or not energy might have more rally left in it to the upside or whether we're kind of topping. But at least for yesterday, energy did very well. All 11 sectors were higher yesterday. The only one that was close to the flat line was utilities. And utilities, that's one of the defensive groups. Personally, I think that's a group that I would be avoiding right now. When we're into the resumption of a secular bull market rally, and I think now after yesterday's action, even with futures down, I believe yesterday's action confirms that we are in the next leg of a secular bull market. And I'll explain why in just a little bit. But if I'm right, I can tell you secular bull market rallies are not led by utilities or consumer staples or real estate, and only to a limited extent by healthcare. Those are your four defensive groups. Where we normally see strength is going to be technology, discretionary, communication services, industrials, financials. You know, normally financials do well when rates go up. Well, rates were going up, financials weren't doing well. The reason why? Rates were going up for all the wrong reasons. They weren't going up because of a strong economy. They were going up because of inflation worries. So you had a lot of folks in the bond market selling bonds because they didn't want a 3% or 2.75% return when inflation was at 6%. So they demanded higher returns. And as a result, we saw the yields moving up and we saw bond prices going down. Well, now we're seeing the flip side. We're seeing yields coming back down because, in my opinion, the inflation scare is over. And as those yields come back down, now yields are coming down for the wrong reason. So normally you would say, well, financials are going to get hit hard because rates are coming down. Well, they didn't benefit from the rates going up in the first place. So I'd be careful about making that correlation that rates are coming down, therefore financials and banks cannot do well. I actually think that with the rates coming down this time, we're lifting the inflation cloud. And when you start to lift the inflation cloud, it works in a lot of different areas, including banks within the financial space. So just be careful there how you look at that. All right, 10-year Treasury yield. First thing in about, 45 minutes or so, we'll be getting the GDP for the second quarter. This will be the initial reading of the GDP. Now, I guess maybe I'm old school, but I still look at consecutive negative GDP readings as a recession. If you want to look at other things, I mean, yeah, unemployment, I should say, still low. I'm sure that's one thing that the Fed continues to look at. I mean, even Jay Powell mentioned it yesterday that in that job market, even though it's weakened a little bit, still remains very strong. Not going to argue. I mean, when you look at the percentages look pretty good. I know there's still a lot of businesses around me, I'm probably sure around the country, looking for workers, trying to find help, can't find help. So I understand that argument as well. But are we producing more goods and services? If the answer is no for 2 consecutive quarters, call it what you want. I don't know, maybe you don't want to call it a recession, but still pretty significant slowdown for our economy. And all these rate hikes, we haven't yet felt all the rate hikes. Rate hikes haven't been going on for that long. And now they've been, picking up the pace. This is going to have even more of a negative impact on our economy in the second half of this year. And you might say, well, why isn't that going to bring the stock market down? Stock market priced it in. Why do you think we went down 25% on the S&P 500? It wasn't based on the news back in January. The market was forecasting. Wall Street had already positioned out of aggressive areas, moved into defensive areas, and the market began pricing in all the issues of 2022. Now we're moving higher not because we're trying to price in what's happening now. The market's pricing in what it sees 6 months from now. I'm telling you, we're going higher. All right, let's move on. S&P 500. So I always like to start off with this talking technically. It's the benchmark. It's what I'm always trying to outperform. And so I think it's a great place just to start any technical analysis conversation. Now, one of the things that I pointed out is when we broke back up above these moving averages, got through the recent price resistance. And by the way, when we had support in here at about 4,100 to 4,200, and we came down here and we held 4,100 to 4,200, then we broke below. When we rallied, we went up to 4,100, 4,200, and that was it. Now, when you look at the last low, we had support that was down around 3,900, maybe into the 3,800s. When we came back up, we got up to about 3,800, 3,900, actually got just a little bit above. Pulled back, it looked like we were going to roll back over. Rotation told us otherwise. But at least on the chart, if you're just following the S&P, it looked like we were going to roll over. And then we turned back up again. I cannot overstate how important this move up has been. Not just the move up here, getting through 3,900, but I said on the pullback, watch to see if price support, prior resistance, that candle body right there was 39.20. This low right here, low close, 39.21. We held price support. We held that rising 20-day moving average. And then yesterday, with the Fed announcement, broke out to a new high. This is kind of a substantial thing. We have not done that. This is the first time technically in 2022 that we have moved through the moving averages, gone back down, tested them, and then broke back out again to a new high. Even the March high, this I still will say to this day, it was more options related than anything. These 4 days right here were really important because there were so many in the money puts at the beginning of option expiration week for the March monthly options that expired that Friday. These 4 days wiped out billions and billions of dollars of put premium. So we did continue to go up a little bit, but came back down, hit that 20-day, and what happened? Nothing. We went sideways, we went below, we came back up, got to about where we were, and then right back down. Hit the 20, failed, right back down. Neared the 20, failed, back down. Here, nice little short-term pop, got through the 20. What happened on the way back down? We failed. Went back down, got about to the 20, failed. A little bit above the 20, near price resistance, failed. Then we come back up above the 20. Now, if the bears had taken this right back down below 3,900 and we started to get some of these big red filled candles, we could have gone right back down to new lows, but we didn't. Instead, we come out with a Fed rate hike of 75 basis points, no small change. We had misses from both Microsoft and Alphabet or Google. And all of that, we get one of the biggest rallies of the year. You look at the news and you look at the stock market and you're like, what in the heck is going on? How can the NASDAQ go up 400 points? Two of its biggest stocks just missed earnings and revenues. The Fed hiked by 75 basis points. I mean, I can see bears collectively throwing their hands up in the air. The market's fixed. What's going on here? It's not fixed. The market's beyond all the news. The market's looking ahead. Now, why is that important? I showed this the other day. I've showed it a couple times. I actually put it in my daily market report to members. This is really important when you come out of bear markets. Check out that test of the 20 and a break to a new high. And I want you to look at, this is 2009. Here was the final low in March of 2009. Here was the move up off of it. Now I want you to look at these 20-day tests, new high. Come back down, 20-day test, new high. 20-day test, new high. It wasn't until this high right here, higher highs and the lower PPO, it wasn't until we had that negative divergence. That was the first time we saw some additional weakness. Until then, that 20-day moving average was gold for the bulls. All right, let's fast forward. Remember 2014 to 2016, all that weakness sideways, double bottom, triple bottom, whatever. Well, let's look at 2016. Let's see what happened at the bottom. So here we had a little bit, went up to just above the 20, came back down, put in this double bottom. Went back through the 20, and this time put in a hammer. Looked like we were breaking below the 20, but we put in a hammer, came back up. Look at all this action above the 20-day until we got to the point where we had higher highs, lower PPO, negative divergence, and then we went sideways and weakened for a little bit for an extended period of time. But when you came out of the bottom, that 20-day moving average was gold for the bulls. All right, how about 2018? Remember 2018? That was the trade war. We'll start in October. Let's go 2019. Yeah, we'll leave 12/31. All right, let's see what happened out of the bottom. Well, here was the bottom. We went up, had a little false move back to the downside and then back up. Got through that 20. Here we went a little bit below the 20, but really it wasn't until we had these higher prices, the lower PPO, then we saw weakness. But again, with the exception of 2 days right here below the 20-day, the 20-day moving average, again, was golden for the bulls coming out of the bottom. 2020 was definitely a different animal just because, we'd never experienced anything, at least in my lifetime, never experienced anything like that pandemic and how the market traded. But we can still see the quick move down the bottom, failure at the 20, head fake, and then back up above. Again, we had a couple of these little minor things below the 20-day moving average. But for the first few months coming out, it was 20-day moving average test and up, 20-day moving average test and up. Came back down here, a little head fake, but then right back to new highs. So let's go back now and take a look at where we are right now. I believe, and I called right here the bottom, I believe we bottomed in June. I said it then, but bottoming can be a process. You can go sideways, you can double bottom. I could be wrong. We could go lower. Lots of things can happen. So what you look for is confirmation. So the first thing you look at, when I look at it anyway, I look back, okay, there was the breakdown. Got to get back through 3,900. That's number one. We struggled twice, pulled back, a couple head fakes to the downside, got through 3,900. Came back down, basically testing 3,900, testing that 20-day and back up again. Listen, if you're bearish, you want this price action back down below the 20-day. I will not be talking about anything other than bullish scenarios as long as we trade over this 20-day moving average. Because I study history and I know this is how we come out of bottoms. This is the type of market behavior. We should not have gone back up through 3,900 here. When we did, we should not have held the 20-day on the way back. Those were two critical changes in what's been happening in 2022 that, in my opinion, strengthens the case that this was the bottom and that we are now resuming the secular bull market. I'll just point out one other thing here, and this is pretty important. when you bottom, and I wrote an article about it. It's in one of my Trading Places blog articles, I believe. But I put a table in there of the last 14 bear markets. And I showed how much the market goes up in the first year from the bottom. If I'm right about that June being the bottom, bear market bottoms, we have seen moves up in the first year from the bottom. The worst 1 year return from a bear market bottom since 1950. The worst one was 29%. If you did 30% off of roughly 3,700, that's going to be about 1,100 points. That's going to take us back to the all-time high by June of next year. That's the worst case based on all the bear markets since 1950. The best case, how about 80%? And I would say the average, the median is probably somewhere around 45% or nearly half. Now, I have said, I believe next year we're going to 5,500, 6,000 on the S&P. I believe that's where we'll be at some point next year. And I said back in January at Market Vision 2022 that I thought we were going to go down to, we could go down between 3,500 and 3,800. And I pointed out end of June. That was back in January. We got the 36, 36 in between those numbers, and we did it in June. The second half, I had basically this going right back up and finishing fairly close to our highs. I still think that's very possible. And if we don't have a September swoon, I would say it's probably more likely than just possible. I would say it's very probable. So I guess the question is, how long are you going to hold off for this bear market to resume? What I would suggest is that you at least consider, as long as we remain above the 20, you can't be in a bear market if you're above the 20-day. And what I mean by that is if you stay above the 20-day. In other words, we're out of the bear market unless we go back below the 20-day. So I would strongly encourage everyone to at least consider that as long as we stay above this 20-day moving average, you give up on your bear thesis. Hey, if we go back down below it, reevaluate. But this market, I would just be careful. Hey, who knows? Maybe today the market absolutely goes down. Maybe we lose 5%. We go right back down and lose the 20-day moving average. Market can do anything it wants. I'm not trying to offer up any kind of guarantee to anyone. I just look at what I see. And I think if you drowned out the media and you just look at the charts for what they are. Hey, I wasn't bullish for 2022. I've been bearish I was bearish all the way through May. It wasn't until this low right here that I turned to bullish. You can go back and read my stuff on all of these rallies. I said, this isn't it. We're not done yet. This rally, I believe, is different. And I do think we're done. Again, if we go below the 20-day, certainly if we get back down to these lows, we'll be reevaluating. I reevaluate. I look at the market every day. But that's what I'm seeing right now. All right, let's talk a little bit about relative strength. Do this kind of quick. XLK. So here's the technology group. First of all, break above the recent highs, go back down, test the 20, test price support, and yesterday, right back to a new high. Look at the relative strength, which had been holding for 3 months. Every time we kept going down to new lows in price, relative strength was holding. Now it's trending higher along with price. Pretty good action. Consumer discretionary. Moving down, moving down. At this low, though, in June, we had come off the low. Consumer discretionary started to see a little bit more money rotating toward it. What's it doing now? Trending higher. Now, yesterday, it did not go back up and set a new high. So we'll want to watch that. I believe we're going to. And if we do, if we can get back through this area right here, I mean, this is kind of a little bit of a sloppy bottoming head and shoulder pattern. But if we get back through that, which you can call a neckline if you'd like, start seeing 158, 159 print on XLY, that would be kind of a confirmation of a bottom here in this group. Of course, consumer discretionary in my opinion. I mean, technology is usually the best performing sector in a secular bull market, but consumer discretionary is a really important group because consumer spending is 2/3 of our GDP. So you always want to see consumer discretionary doing well if you're bullish the market. So that's what I want to see. That's one of the steps ahead. You know, if I got a to-do list, this is going to be on it. I want to see the XLY breakout. Last one I'll show you is the XLY XLP. I mean, here you can see it also went to a low in May, did not go below it. Came back up here in July, took out that early June high. Now it looks like we got this pattern of higher highs and higher lows going. Came down, bounced off the 20, turning back up. Now, if you recognize this pattern right here, very similar to what we saw in March. Up through the 20 and the 50, pulled back, hit the 20, which was above the 50, pulled back, hit the 20, which was above the 50, had a little bit, one more bounce, had one more bounce, and then fell apart. So again, big question on the discretionary stocks. Which way do we go from here on a relative basis? If we break back down, yeah, that would not be good news for my bullish case. I wouldn't say it's the only news, but this is pretty big. XLY XLP ratio is pretty important to me. So yeah, if this breaks back out again to a new high, you're going to hear more and more bullishness coming out of me. If we turn around and go to a new low, break down below this double bottom, I will be open to the possibility that this bear market's not over. Anyway, that's where that stands. Earnings spotlight. I just want to show you Microsoft yesterday. Look at that move. That was after they missed revenue and earnings per share. But look at Microsoft relative to the software group. It's been a leader. It's one of the leaders. What you have to be careful about going into earnings is when you have a company that's not a leader. Meta platforms right here versus the internet group. It's down close to a 52-week low. And the internet group just set a 52-week low relative to the S&P. So by association, Meta is one of the worst performing stocks out there going into its earnings report. And of course, it came up short. And this stock is not getting the same treatment. When I looked pre-market, it was down, I don't know, $8 or something. See where we are now. $8, 161. I've still got an hour and 19 minutes to go before the market opens. And this is why I say relative strength is so important. I did not trust Meta going into its earnings report yesterday at all. Did not like it. And relative strength was the primary reason. You look at Microsoft or even Google. Let's pull up Google. Google, one of the strongest right here, one of the strongest versus the internet. And it came up pretty nicely. Anyway, let's go on to the three you must see. I want to do this real quick. I'm going to start off with crude oil. Look at us down here with support, $93 a barrel, but we can't get through the 20. We're squeezing. We're in a $7 range, and we're up a couple bucks to 99 today. Can we get through the 20-day, or do we reverse and go lower? That's one thing to watch. Next up, semiconductors. What are we going to do here? Went up, coming back down, held the moving averages, trying to break back out again. Good action there. Software with that Microsoft bad news, software coming up, trying to get through 4,400, triple top. This is now a quadruple top. Can we get through? This is kind of big. All right, that's it for me. Appreciate you tuning in. Hey, do me a favor. If you're not already an Earnings Beats Digest subscriber, go over to earningsbeats.com, scroll down, name and an email address, no credit card required. Make sure you subscribe. Anyhow, listen, everybody have a great day. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.